we know. There are things that we know we don't know, and there are things that we don't know we don't know. Okay, so think of that framework for a second. There are known risks. There are risks that we know are ahead of us, but the outcome is uncertain. And then there are these risks that are sort of these black swan events, these unknown unknowns where you never can anticipate it. And such events could be what happened on 9/11 is an unknown unknown when terrorists hit the World Trade Centers. What happened in 2008 was another unknown unknown because suddenly overnight you had these big banks marking down the mortgage portfolios in their books by 20%, and it led to a financial crash. And then you could also look at earlier this year as an unknown unknown because we knew there was a virus coming from China. We didn't really understand what the widespread impact would be on the country. And especially when things were, really ravaging in New York City, no one knew how bad that health risk was at the time. So I look at that as an unknown unknown. Now, as far as the election goes and perhaps another coronavirus wave, these are known risks. These are things we know, but the outcome is still uncertain. And because the market can see these risks, investors go ahead and they hedge their portfolio or they buy insurance against their stocks because they know the outcome is uncertain and there's risks to the stocks. And that's a good thing because you can think of it like if you know there's going to be a chance of rain, well, you'll bring your umbrella, right? Don't you hate those days when the weatherman says there's going to be no rain that day and then you go out with no umbrella and you get torrential downpours? God, I hate that. But that's what happened to us in February and March. It was like the weatherman said, there's no chance of rain, you're fine. And next thing you know, you're caught in a tsunami. And then right now, we know that there is going to be a chance of rain around the election. So market investors, institutional investors, have gone ahead and bought puts and insurance against their portfolios. And even though we might see a drop because there's always some type of chaotic trading around uncertainty, I don't think the drop will be anywhere near what we saw in March. Actually, I'm confident we won't see what we happened in March because investors are ready for this. We're braced for it. We've got our umbrellas. We bought our insurance. So things aren't going to be as bad. And I think if we do see a 5 or 10% sell-off in the markets, I mean, unless there's a civil war or something breaks out, obviously, then all bets are off. But if there's uncertainty around the elections, we have another win or a week or so about the outcome, and the market sell off 5 or 10%. I think it's going to be a great buying opportunity. So right now we're looking at uncertainty, but it's a known unknown risk, and so that's how I'm thinking about the election going forward. Past the election, I think retail sales for Christmas are going to be strong. I think a lot of Americans have cash on because of the stimulus payments, and also the economy is starting to come back from the lows of the summer. So I think the end of the year is going to be strong. We're starting to see it in some of the economic data. So that's what we do have to look forward to. Now, as I told you, we are going to go over every position right now because some of you have written in and there's some stocks that I haven't discussed every week. So let's do it this week. So check out my charts right now. So I'm going to go through this alphabetically, and this is the Automatic Fortunes portfolio right here, all our stocks. And I'm going to start with AMD. AMD actually had huge news today. They made a $30 billion acquisition of Xilinx. Xilinx is another chip maker. Their specialty is in mobile chipsets. So it opens up AMD's total addressable market, which was $80 billion total addressable market, and now it's about $110 to $130 billion. So right now, AMD is down. You can see it's down 4.28% on the day, but this deal is accretive to earnings. I'm sure there's just merger arbitragers who are shorting the stocks and buying Xilinx. I think if this gets down to the $73 range, you can keep buying more. This is going to be good news for AMD in the long run. They still focus on chips for data centers, and then they also have the Sony PlayStation 5 and the Xbox X coming out this year. So not selling AMD now. We've got in the stock around 40. I still like the stock, and I think it's going higher in the next year. Aptiv, another stock that has done really well over the last month or so, and this one is just in a simple range. It's still in an uptrend, but you can see it's starting to form a little bit of range. I did think this stock was going to break out above 100 last week. It did get to about 101. It didn't really start running, but I do think that it's going to pull back and gain some momentum to surge forward just because of the opportunity here with self-driving vehicles, with the electrification of cars. Aptiv is the auto parts supplier you have to own in the space. Let's look at Americold. Now, Americold's chart has been kind of sideways for a while. It is a REIT, so it's not a typical growth stock. It's a real estate investment trust that buys refrigerated warehouse spaces, and it's a play on online grocers. They just bought the fourth largest commercial warehouse or refrigerated warehouse space in the world, and Americold is already number one. So this is going to give them even more market share. It's starting to consolidate. I think that this is a good thing right here, this little flag pennant trade, and I think we're going to see a breakout to the upside. EnerSys makes batteries, and you know how popular batteries are right now, but they don't make the kind of batteries that you're going to put in your garage and run your solar system off of. EnerSys makes batteries for trucks and small trucks, these little trucks that they have in warehouses. So it's another play on e-commerce. It's done pretty well for us since we bought it. I think we got in around 65, but then we had that big drop. I know some of you added to this and the lows in March. I still think the stock's $71. It could be $90 to $100 stock in the next year or so. So we're not doing anything on EnerSys. Just hold on to it if you have in your portfolio. Generac has been on a tear the last couple of months. Now, the big news with Generac is they make generators, and you see what's happening with the wildfires out west. People have to buy generators. We've got hurricanes here on the East Coast. I bought a generator myself this year. The other play on Generac is that they do storage solutions for the house. So they also sell a battery that you can put in your garage. That's part of this whole big solar play. In fact, when I was calling solar dealers, they were trying to push me on the Generac batteries, even though I heard that the Tesla ones are better. But I still think this stock has more upside. It's just been consolidating near the highs. And whenever you see something like this, after stocks had a big run and you start to see it consolidate with lower volatility, you can bet on it that the next move is going to be higher. Another thing on Generac, there is a Wall Street strategist that put a $285 price target on this stock. So that sounds great. If it gets to $285 in the next year, that is going to be a home run trade for us because we got into the stock at around $90 a share. Inseego has been a little bit of a laggard for us. Not that much stuff going on right now because we're still waiting for the 5G rollout. And basically, you're going to be able to buy an Inseego modem that connects to the mobile networks. And instead of having broadband in your household, you will be able to use your 5G signal. Now, I was bullish on this stock at $4.50. It ran to $9, and then it sold off in March. We had an amazing opportunity after the earnings call. I said, this is a $4 stock, and it is going much higher because the CEO just said on the earnings call way down here that they see unprecedented demand for their hotspots. Because think about it, if companies have to send their workers home, they need mobile hotspots to access the internet. Another thing with kids doing homeschooling, they need internet access, and they can get it by using a mobile hotspot. Now, that whole trade where the children are not going back to school is not happening anymore because schools have opened. So they're losing that market for hotspots, and that's one of the reasons why this has been weak. But the 5G modem business has not really kicked in yet. Okay, so that's why the stock is selling off. I think it's going to be an $8 to $10 stock range until we start seeing those 5G modems. And this is a 2, 3, even 5-year play as millions and millions of customers who have broadband realize that it's cheaper just to get their home wireless signal from their mobile. So you can do it all in one plan. You buy the modem, you put it in your house. It's not happening overnight. If this stock trades back down to 8, you should buy more of it. But right now, I think we're just kind of in a little holding pattern right now. So Inspire Medical Systems, this is another one that's been in a really solid uptrend. We bought in this stock around 80 about 4 or 5 months ago. And the stock had a little bit of a pullback in the last week. It hit a high of 135. The street is still bullish on it. I'm still bullish on it. Medical technology is very hot right now. And I think support which is where it just bounced from. It bounced off the 50-day moving average. Oh, by the way, I should have said this from the start, but these two lines, the blue line and the yellow line, these are exponential moving averages. So this is a 50-day moving average, and this is a 200-day moving average. This is usually the first level of support, and when things get out of hand, they usually go down to the 200-day moving average, which happens to be a amazing opportunity to buy a stock that's in an uptrend if you can get it at the 200-day moving average. But if you look at this, the 50-day moving average during this uptrend was ticked just about here. Well, it was ticked first in April, and then it came down in June, again in June, and then in July, and looks like we just went down to the 50-day moving average and pushed right back up in, when is that? That is mid-October. Sorry, that's just a couple days ago. So Inspire still looks good. I think this stock is heading to 150, if not 180 this year. JD.com. This is an e-commerce play in China. China had great news on their economy. They're growing over 5%. We can argue whether or not that is believable or credible information or not, but you see in China, they've opened up bars and restaurants and people are out doing sambuca shots, and in Wuhan, they're having concerts. And so investors are getting increasingly bullish on Chinese stocks, and this is my favorite play in all of Chinese technology, just because they're already partnering with US companies, and they've got this huge logistic network that reaches 90% of Chinese citizens, and it's a huge market, 1.2 billion people. So JD.com looks great. It's starting to consolidate near this high. We hit a high in September of $86. We're seeing this fly pattern, and you see a lot of this happening in the charts right now, this kind of consolidation pattern. The reason for that is we have this uncertainty that I talked about next week, where investors are not really sure, so they don't want to take big risk buying, and they don't want to take big risk by getting out of their positions. It's kind of a wait and hold thing. I think somebody joked a week ago that every day for the last couple of weeks has felt like Summer Friday, because there's just been really low volume in the market. You can see down here as volume has really tapered off in JD.com as everyone is waiting to see what happens at the election. So Kingsoft, which is ticker symbol KC, is one that we bought 2 months ago. And this is a cloud provider in China. It's a private cloud. It's not one of these big public clouds like Alibaba or Tencent, but it's a smaller cloud company, and they're gaining market share because many of the Chinese tech companies want to have multiple clouds. So they go on the giant public cloud and then they join one of these private cloud companies, and KC is picking up market share there. It did drop after earnings. It hit 27.5. It's consolidated and started to trend up since then. Nothing to do on this stock right now. I think this one is going to go higher. Invitae has been a big winner for our portfolio this year. This is a genetic testing company. And when I saw this trade and when I read about it, it's one of those trades where you say, this is going to be awesome. Because if you look at the technology and if you see that the cost of a human genome or sequencing a genome has gone from billions of dollars a year 20 years ago to $100,000 a year in 2010 to $1,000 in 2020, and the cost will continue to drop. And so I see a future where everyone walks into their doctor's office and you get your blood work done and your blood pressure, and you're also going to have a genetic screening to see if you have a genetic predisposition for particular diseases. And the more data that this company can acquire, the more useful that data becomes, because there will be more certainty if you take an algorithm or a machine learning program and you look at outcomes versus people who have certain genetic traits, and there's more of a correlation, then that data becomes more valuable. They bought a company called Archer, which does screening for cancers, back here in June. And since then, the stock has just taken off. It went to 30 and then it traded to 55. It's had a little bit of pullback recently. It looks like it's bounced. The other thing I have to tell you about this is that it's a huge holding for ARK, which is a wildly popular ETF company, ARK Investment Management. They were early on Tesla as well. And I think they were even early talking about Bitcoin in 2015. So investors are now looking through whatever ARK owns and buying it and bidding it up. Invitae has been fortunate. There hasn't really been news on the company. They didn't have earnings or revenues or forecasts that were any better than expected. But the good news on Invitae is that ARK owns it and everybody else wants to own it. So right now, if you're in the stock, I would say don't sell it yet, but be careful if you're chasing it up here, because this is a very risky stock. It went from 32 to 60 in almost 60 in a little bit of a month. So, it could have a sharp pullback if the market starts to roll over. Now, Qualcomm is a stock that owns half of the mobile chipset market. It's a huge play on 5G. We got into this one at about $80 a share. It hit 130 recently. It's starting to pull back, consolidate like everything is right now. I still think that the forecast is going to be higher for Qualcomm. The main reason is I think that iPhone sales are going to surprise to the upside, and that's going to be a driver of Qualcomm. It's going to be a driver of all the chips. The reason why I think Apple is going to sell more than people expect is because I've been looking. It doesn't matter how great the phone is. What matters is how the telcos subsidize the new iPhone. So if you look at like AT&T's website or T-Mobile's website, they're giving crazy incentive deals for you to sign a new longer-term mobile wireless contract with them, and they'll pay for your phone. AT&T or T-Mobile is giving you $850 towards the purchase of a new iPhone, and that is why Apple's going to sell a lot more. Obviously, T-Mobile will make that money back through their long-term contracts, but it just shows you the power of these mobile distribution networks to sell these new products. And it used to be when Apple had a new phone, I lived across the street from the Apple store in New York City, and you would just see, how long the line was. Obviously, no one's going to the store to buy the Apple phones anymore. They're doing it online. But what I think is more important is how much are these subsidies? Like how well will these mobile telecom companies subsidize a phone? And from what I've seen so far, the iPhone 12 is going to sell better than people expect. SolarEdge is another solar company. We got out of this position though. We sold some, I think, at 170, then we sold the rest at 275. It ran up to 320. You never get the exact highs or the exact lows, but you have to make sure that you're selling when you do have the opportunity to. The stock is now pulling back. There was an amazing bid in solar companies because of potential Biden victory and what that means for his potential Green New Deal. And now investors are selling it because maybe there's a risk that Biden doesn't win and the solar companies aren't as beneficial, or maybe they just got too far ahead of itself. When we sold SolarEdge, I showed you that the valuation was 60 times earnings, and the stock usually trades 20 to 30 times earnings. So until earnings start to come around, you were paying a crazy amount for the stock, and it was time to take a profit. I think we tripled our investment in SolarEdge, so that was a good trade for us. Splunk, my favorite machine learning company, had some positive news out just today. There are some Wall Street firms that reiterated their buy ratings on it. There's price targets at the 250 to 270 range. If you bought into the stock with me down below $100 or $110 when we first put the idea out there, no reason to sell it right now. It could consolidate. It did have a little bit of a dip down here right to the 200-day moving average. See how well this works sometimes? It dropped down to the 200-day moving average and then bounced. The stock is now once again consolidating just with about everything else. And I still think we have some more upside in Splunk. So don't sell it just yet. SunPower, another solar company that ran up with the rest of the solar index. It's now starting to pull back a little bit. SunPower a little bit different than SolarEdge. SolarEdge makes these microinverters which convert the sun's rays into electricity you can use in your house, whereas SunPower makes and distributes panels. They also have a battery, so they're a battery play. And this one's down a little bit today. I think this could trade down to about the $12.50 to $14 range, but the reality is that these stocks are going to be higher over the next couple of years because we're going to start seeing increasingly more solar installations, not just because of subsidies, but also because of the batteries you can add and make these systems much more efficient. SunPower makes the most efficient and the best solar panels out there. So keep hold of this company. And I think, we're going to be really happy in the next couple of years. Square is a fintech company that does a lot of different things. They are point of sale providers. So they give you little iPads that if you're a merchant, people can swipe their credit cards at checkout. The big play here, though, is the Cash App. And the Cash App has been growing significantly. They allow you to buy Bitcoin on the Cash App. You can also, there's some stocks that you can purchase through it. So the big play with Square over the next couple of years is that they're going to start rolling out more and more financial services. And if you look at the value of a customer to a bank, the lifetime value. So anyone that has a relationship with Citibank, the average lifetime value is about $3,000. Now, the average lifetime value for somebody who has a Square app is about $300. Okay, so the lifetime value of a Square subscriber is only 1/10 that of what the banks value a customer at. And this is going to go up significantly because Square is going to get into the mortgage business. They're going to get into the auto loan business. They're going to be everywhere. And the key here is that they can acquire new customers for a fraction of what it costs a bank. It costs a bank about $300 for you to open up a bank account. And that's how much they, per user, that's how much the banks actually have to spend in marketing dollars. For Square, it's about $30. So Square can much more easily get new customers. And on top of that, millennials, who are the main users of Square, are the big target audience because they're the ones who are going to be buying cars and houses and putting more money away over the next couple of decades. So I think Square is going to basically disrupt all of the banking industry when it comes to the bank's relationships with consumers. The banks are stuck with, these legacy real estate assets. Nobody wants to go to a bank anymore. I just want an ATM. I never want to step foot inside of a bank. I don't care if you give me a lollipop or give my dog a treat. I don't want to wait on a line in a bank. Maybe that's just me, but I just don't need to have a personal relationship with my banker. I just want to make sure that when I check an app, it works and my funds are there and I can send that money easily. And that, I think, is the benefit of what Square offers. And it's just a super disruptive company. It has sold off the last couple of weeks because PayPal announced they were going to allow their users to buy Bitcoin and other cryptocurrencies. So Square's Cash App and PayPal's Venmo app are two big rivals. And now PayPal does something that only Square did, and that's why people are selling Square. I think it's a mistake, and I think the stock is going to go higher over the next couple of years. Let's talk about Trulieve. Trulieve Cannabis Corp is a dispensary. They're mainly based in Florida. They've got 40 or 45 stores in Florida. They've got 65 stores total nationwide. They just opened their 65th up last week. We bought this stock around $10 or $11 a share. I loved it because when I looked at all the marijuana companies, they were the only ones that were profitable. So for me, it was easy. Just buy the one that actually makes money. The rest of these, Canopy and Afria and all these other ones, they're very speculative. They don't make money. This is a simple business. They grow the marijuana plant in Florida. They produce it. They create their edibles and whatever. I'm sure some of you understand this much more than I do, even though I've been to one of their dispensaries here just for due diligence purposes. And they have, an amazing growing network of stores in Florida. Wall Street loves the stock. I think there's price targets from like $45 to $65 a share. It's looking good right now. It's moving up. It might be moving up on speculation that you get a Democratic wave and you start to decriminalize marijuana on the federal level. And so that's why investors are really, bidding the stock up or have moved up about 25% in the last couple of weeks. Keep in mind, if the Senate stays Republican, all this marijuana legislation is not going through. So if the Senate is red on election day, then I would expect the marijuana stocks and perhaps even the solar stocks to have a little bit of a pullback. The future is still bright, though. So when it comes to solar and marijuana, if you do get a pullback, I think you will have a buying opportunity. I just want to check in on Tesla. We don't own the stock anymore. We sold it on this day is when I put that order, that recommendation out to sell. It closed at 475 that day. It's at 421. After that, Tesla is just forming this huge flag pattern. And this is one of those trades where maybe some of you still own it. I know some of you wrote in and said, I'm not selling my Tesla. It's going to 3,000 or whatever. This is one of those trades where it reminds me of Bitcoin in 2017 because it had this crazy move up. It went up basically 10x from the lows. And then it had this big drop where it shook out. Anyone who bought here in August basically got shaken out. Okay, so now we're just kind of consolidating with the longer term investors. If you're long Tesla, this is usually a good sign because when the stock moves, it's going to break out of this range at some point. It tried to, right here, I think this was battery day in mid-October. It tried to break out, but it failed. And now it's back in this range. But eventually will break out of this range. I think it could break out to the upside just because I've been looking at, and just because we don't own Tesla doesn't mean I don't still follow the story. Let me just clarify that. But I've been looking at all these new electric vehicles that are coming to market. And most recently, Volkswagen has come out with the ID.4, which is like a mid-size SUV, and it's electric. And the specs are similar to Tesla's. The price range is the same. And then, they get the same range, about 300 miles per charge as the Model 3 and the Model Y, and the price range is the same. Then I looked at the 0 to 60, and it's double. I mean, the Volkswagen goes 0 to 60 at half the speed Tesla does. It does it in like 8 seconds, whereas the Tesla Model 3 does it in 4 seconds. And so from that perspective, I mean, if you're a guy and you're buying a car, most guys look at the cars and they're like, okay, they're the same price. Which one goes faster? And then they buy the faster one. That's what I would do. And so that's why I think that Volkswagen is going to have a hard time catching up to Tesla with their ID.4, which is supposed to be a big selling product for them. They're putting a lot of advertising and marketing into it, but they still don't have the same specs. Now, on top of that, they don't even offer you autopilot for free. So Tesla has autopilot, and then you can buy full self-driving for another $8,000, what the cost is now. Even though I don't want to get into it too much, but Tesla's full self-driving is having more issues once they've released it than we thought it would have. And I think that's weighing on the stock a little bit. But I mean, this is kind of an apples to orange comparison. And one of the reasons why I think Tesla is going to continue blowing away all major auto companies over the next decade. Having said that, the stock is worth double the combined value of GM and Ford. So it's very well priced in. If Tesla is to go higher, it's going to be on the back of an autonomous taxi network, right? It's going to have to be a big player in the mobility wars. And I'm not seeing that right now with full self-driving. I think Waymo and GM's Cruise are already ahead of it. And we are going to keep paying attention to this because one of these companies is going to take a huge chunk of that $7 trillion market. And that's why Tesla is worth just keeping an eye on for now. Uber has not been doing very well. I was asked about Uber a couple weeks ago, and I said the thing with Uber is that this one is not going to do well if we have another coronavirus wave, because people are not going to go into the backseat of a random car with a driver they've never met if they're worried about getting coronavirus. And we're seeing cases move up around the country. Hey, you want to say, well, we're doing more testing. Well, that is true, but we are seeing more cases. And I think it's people are reluctant really to travel now. So you're going to see the airlines start to drop. You're going to see the restaurant stocks start to drop, and Uber is, one of them. Now, having said that, I don't think this stock is a sale. I think it could trade down to about 30, maybe the $28 to $30 range. But I think that once we do have a vaccine and we're past, coronavirus worries, you're going to see this stock come back with a vengeance, because all of these travel and leisure stocks, which have just had much pent-up demand, are really going to outperform once that vaccine happens. So I want to keep this in the portfolio, even though I think it could be headed lower, just because of what we could see if the vaccine is pulled forward ahead of schedule. So nothing to do on Uber right now. Now, Verra Mobility is a stock that we bought about a year and a half ago, and we're down about 10% in it. At one point, we're up about 70% in the stock, and then it got hit on coronavirus. And this is another one that's levered to COVID because they have a system that allows rental car companies to easily pay tolls throughout Europe. So if you rent a car, let's say in France, you're driving around Europe, you use their app, and it makes it really easy for you to navigate all the toll roads. Now, the other play on Verra Mobility is that they're a government technology company. And that might sound like an oxymoron, but what they do is they have red light cameras, and they also do cameras on the end of school bus stop signs for the idiots who drive around school buses when the stop sign is out. And I think this company is going to benefit if we see a blue wave, because if we see a Biden as president and a Democratic Senate and House, we're going to see a big infrastructure bill. And that's going to benefit companies that are making roads smarter. And that's essentially what this company does. It's making roads smarter in the sense they're putting up speed cameras and red light cameras, and they're allowing us to enforce laws on roads without needing more manpower. And so I'm still bullish on Verra Mobility. I think it's going to have a little bit of a tough time here with coronavirus as well. But I think the long-term forecast, especially if we see a blue wave in the election, it is going to be positive for the stock. And if we don't, I still think we're going to get an infrastructure bill in Trump's second term. So even if Trump wins the presidency and maintains control of the Senate, I think we're going to see an infrastructure bill. I think there's a higher chance of it if there is a Democrat president and Senate. So Vroom is a pick from last week, and this one has not done so well. We're down about 20% in it. And what happened is they raised more capital, they sold more shares, they raised about $600 million, and that was kind of dilutive earnings. It's trading close to the lowest price it's been since the IPO, and this is always a strong layer of support. So I think we're going to see a bounce in Vroom. I looked at Carvana, and that stock looks actually pretty good. Looks a lot better than Vroom. And so that keeps me bullish on Vroom. Now, Vroom had this problem where when the pandemic hit, they basically sold all their inventory because they didn't want to be stuck with cars that were depreciating in value and worried about, a Great Depression. So the CEO didn't see that the economy would snap back as fast as it did. So recently, they've just been trying to acquire as much inventory as they can so that they can resell it. And they make about $1,500 to $2,000 per car that they're able to buy and sell. Now, keep in mind, we're talking about these short-term fluctuations in the stock. And this is a total addressable market that's something like $850 billion a year. This company, and including Carvana, don't even make up 1% of that total addressable used auto market. So think about it from this perspective. If you drive anywhere in the country, there's used auto lots everywhere, and you have to go and negotiate with the used auto sales guy. And I don't know if maybe it's equivalent to a root canal, but a lot of people don't like this experience. And this takes that experience and makes it much easier. So you can just find a car you like online, you order it from your couch, and then you don't have to negotiate with anybody. The price is the price, and there's a lot of certified pre-owned. So the good news is that there's so many cars that are coming off these 3-year leases, it's adding more inventory. So it's creating a bigger market, and it's easier, right? If you're buying a used car, it's easy if you're just buying like a BMW off a 3-year lease because you know what you're getting. The car has 30,000 miles. If you're buying like a 2002 Honda Civic, you have to bring your mechanic. You probably need to be a mechanic yourself to fix the thing. But the market for used cars is changing. We don't buy cars that are 10 years old. We buy cars that are 3 and 5 years old in the used market. And that's why I think this stock has incredible potential for the upside, just because the market that they're addressing is so big, and there's just such a small fraction of it. Even if they gain 5 or 10% market share, you can see the stock being up 4 or 5x from where it is right now. And lastly, we come down to Zillow, which is very similar to Vroom. It makes the experience of buying a big ticket item easier because you get more information. right in front of you, so you can easier to comparison shop. And Zillow, which hit a high of about 111, has sold off. Actually, the last couple of weeks, everything has been red, even though the housing market has been stronger than expected. Don't worry about that. Zillow is one of these stocks that is going to be much higher in the next couple of years ahead. I think their big business is not in their marketing of homes and creating this database, but actually going and becoming a giant real estate investment firm. So their iHomes division will buy your house from you with a cash offer in 24 hours. I don't know anybody who needs to sell their house in 24 hours. Maybe perhaps if you have a deceased, relative that you have to liquidate the estate for one reason or another. You need to get out of the house in 24 hours. Zillow will come up with a bid, and then they come in. They've got a team that will fix up the house, and then they will resell it. And because there's going to be so much turnover in the next couple of years with millennials moving out of cities into the suburbs, the next generation moving into cities, I think Zillow is going to be, one of those cult stocks where people will just keep buying the stock. And I see it being, double or triple just in the next couple of years. So we got into Zillow at $40. If you're holding it or you sold some, congratulations. I wouldn't sell just yet. And from a technical perspective, it's bouncing off this 50-day moving average. So we could see a little bit of support here. Remember, if things do get out of hand because of the election, keep an eye on these 200-day moving averages for support. So that's it for this week's webinar. It was a long one. Hopefully you were able to get information on every stock in your portfolio. And don't forget, Thursday, 1 p.m. Eastern time, I'll be at the New Era Fortune Summit.